Yeah, market news now. Gold prices climbed to hit a historic peak as central bank purchases amid geopolitical tensions sustained the momentum for the yellow metal, while strong U.S. economic data failed to dampen gold's allure. Investors are waiting for earnings reports from big U.S. banks to gauge how corporate America has been faring in the current high interest rate environment. Today marks the unofficial start to the quarterly earnings season, with results from three major U.S. banks: JP Morgan Chase, Citigroup and Wells Fargo. To give us more perspective on the markets, we are joined by Roy Mutuni, who is from Sanlam Investments. Roy, thank you so much for your time. Let's talk about market sentiment right now, especially when you consider the fact that earnings season has officially kicked off, but we've also had to deal with that US CPI report.
Hi, thanks for having me. So market sentiment is very bullish for commodities, anything related to oil and gold. As you saw, the oil price is now is now around 90. Gold is at all-time highs. So when you're looking at the top 40 or the ALSI, the stocks to look at are the commodity stocks: Harmony, Goldfields, Anglo Gold, and the platinum group metals as well. You're seeing those stocks up more than 5 or 6%. So from that perspective, quite bullish. The rest of the market is very muted and actually going backwards, to be honest. So there's a clear separation between the sentiment on one and on the other. And I guess on the one side, on the commodities side, I think higher inflation for longer is probably a positive thing. And the fact that economies are continuing to grow, particularly the US, despite having high rates, is putting a bit of an underpin on those stocks.
So let's build on what you've just said now around the commodities. Is that the signal you're taking from this run-up in commodities? And if so, is this a short-term thing, or is this something that could go into the medium term?
So if we separate gold from precious metals and the other commodities, I think gold is basically telling you that there's a premium right now for geopolitical tensions. There's an underpin for demand in the demand for gold from central bank purchases and significant uncertainty into the future. That's the environment that gold tends to do well. You'd also argue that gold shouldn't do well when interest rates are this high, but it's clearly the drivers for positive gold movement are outweighing all of this. And maybe it's even telling us that the neutral rate for interest rates in the US is a lot higher than it is right now. So basically, interest rates are not as restrictive as the economy is, as the Fed is saying. This is a short to medium term trend. As you can well imagine, the Fed's not going to make decisions on interest rates based on one data point. But it looks, when they look out over the next 6 months, they seem quite comfortable with where rates are. So that's an underpin for markets, and that's an underpin for equities to run, particularly if we find that earnings have actually held up in that first quarter.
So yesterday locally, we saw We Buy Cars make its debut on the JSE, opening at 20 Rand, and currently looking at the share price, it's trading at around 20 Rand 51. What do you make of this unbundling? Is there value here within either We Buy Cars or Transaction Capital?
So that's an interesting way to phrase it. If I start with We Buy Cars, I mean, this is the sort of listing that we want to see on the markets. It was a startup. The founders are still associated with it. They've gone through the whole evolutionary process of growing it into a big enough business to list. And now they've been able to exit part of their shareholding, but remain there to realize some of the growth into the future. It's a perfect company that needs the sort of platform that the stock exchange gives. They are definitely a business that provides a service that the market needs. I think one of the things that they gave, one of the indications that they gave was that people struggle to sell cars directly to each other, and they provide the platform for that. So from that perspective, it's a necessary service. It's really big in its industry. And it's just made life easier. So from that perspective, I would say it's a solid business. I mean, clearly the investor has to assess for themselves what the what the long-term growth prospects are in the context of this of the economy here that's growing at 1 or 2% at best. But from a stock exchange perspective, we're very happy to have this company listed.
All right, so let's stick with the local theme. What's your thought or conviction around, SA Inc. stocks? I mean, some analysts that we've had of the show have spoken about some of these low valuations and, these multiples rather, and it might create a bit of a value trap as they appear a bit cheap. What do you make of it?
So here's the thing, everything's gone against them. Foreigners leaving the market, Reg 28 encouraging you to take money offshore, bond yields going up really high, no GDP growth, pretty much everything's gone against these stocks. But when you look at them, there's still some that are eking out, even if it's high single-digit growth and some cash flow and paying out dividends, you find that there are some gems. For me, the value trap argument is valid, but as an investor, and particularly when you're looking out into the medium term or longer term, what's really important is ask yourself, do these companies compound value? So are they earning returns ahead of their cost of capital? Cost of capital is really high right now. So if you find gems in the market that produce at least the cost of capital or even more, all you do is you buy them and hold on to them. What will happen is over time they'll grow their equity base, and when enthusiasm comes back to the market, that will be reflected in the share price. Because markets are very cyclical, but value creation compounds in this way. If they're destroying value, clearly the opposite happens. I think there's some definite gems there. I think investors should look at these companies because there's, like I said, some definite gems, but obviously you have to be very careful. In a no-growth environment with high interest rates, there are companies that have very poor balance sheets or that have a very poor competitive positioning that may actually result in them going out of business or not earning returns.
Roy, let's leave it there. Thank you so much for your time. That is Roy Mutuni, is a portfolio manager at Sanlam Investments. And as I mentioned, U.S. earnings season has already kicked off. We already got results from JP Morgan reporting a rise in profit on the back of interest income. However, Wells Fargo going the other way, reporting a fall in profit. And that's because they've earned less when it comes to customer interest payments. However, we'll keep abreast of all of those, including some of the results coming out next week. However, we're going to take a quick break. When we come back, we'll have SME on point with Diabo Seto, so stay tuned.